3 low-risk investments for first-time investors. Steady growth. Smart strategies. Building wealth doesn't have to involve high stakes or sleepless nights. What makes these investments so reliable? Are they truly as safe as they seem? In this video, we'll explore 3 low-risk options that can help you grow your money without the fear of major losses. But before that, make sure to like this video and subscribe to our channel to watch more videos like this. Let's start from number 1. High-yield savings accounts. A simple way to grow your money. What if there was a way to earn better interest without taking on any significant risk? A high-yield savings account is one of the safest and simplest investment options available to beginners. These accounts, typically offered by online banks, offer interest rates significantly higher than traditional savings accounts. While the returns aren't going to make you a millionaire overnight, they provide a hassle-free and low-risk method for growing your savings. Why HYSAs are perfect for beginners. Super low risk. One of the best features of a high-yield savings account is that your money is insured up to $250,000 by the FIC, Federal Deposit Insurance Corporation. This means there's little to no risk of losing your funds due to bank failure, making it one of the safest ways to grow your money. Liquidity. Unlike other low-risk investments, such as certificates of deposit, CDs, which lock up your money for a set term, you can access your funds in a high-yield savings account at any time without incurring penalties. This gives you flexibility, which is especially important for emergency savings or funds you might need to access quickly. Higher interest rates. Online banks tend to offer significantly higher interest rates on savings accounts compared to traditional brick-and-mortar banks. This allows your savings to grow more quickly, even if you're not taking on riskier investments like stocks. While the interest rates won't make you rich, they're still an improvement over traditional savings accounts. What are the drawbacks? Low returns. While the interest earned is better than a typical savings account, it's still much lower than more aggressive investments like stocks or real estate. If you're looking for substantial growth, this might not be your best option. Inflation risk. If inflation rates are higher than the interest rate you're earning, the purchasing power of your savings could decrease over time. This means that even though you're earning interest, it might not be enough to keep up with the rising cost of living. How to get started? Starting a high-yield savings account is easy. You can open an account with online banks such as Ally Bank, Marcus by Goldman Sachs, or Discover Bank, which are known for offering competitive rates. Simply research which bank offers the best rates. Open the account online and transfer your funds to start earning interest immediately. Number 2. Certificates of deposit, CDs. Lock in your earnings with fixed returns. What if you could earn interest on your money without worrying about market swings? Certificates of deposit, CDs, are time deposits offered by banks, which pay interest over a fixed term. The concept is simple. You deposit a sum of money into the CD for a specific term, and in return, the bank guarantees a fixed interest rate for the duration of the term. At the end of the term, you receive your initial deposit plus the interest earned. Why CDs are great for beginners. Fixed returns. One of the best aspects of CDs is that they offer fixed returns. You know exactly how much interest you'll earn, and there are no surprises. This makes it a great option for those looking for predictable growth. Safety. Like high-yield savings accounts, CDs are typically insured by the FIC up to $250,000. This means your principal is protected, and you don't have to worry about losing your money. Easy to understand. CDs are straightforward. You choose the term length, anywhere from a few months to several years, and the interest rate. Once the term ends, you receive your original deposit plus the interest. There's no complicated process to follow. Are there any downsides? Early withdrawal penalties. If you need to access your money before the CD's term is over, you may face significant early withdrawal penalties. This is a major downside for anyone who might need liquidity during the investment term. Missed opportunities. Your money is locked up in a CD for the duration of the term. If interest rates rise or more attractive investment opportunities become available, you won't be able to take advantage of them until your CD matures. How to get started? To get started with a CD, visit a bank or an online platform such as Marcus by Goldman Sachs or Capital One. Compare the rates and terms offered by different banks, choose the one that aligns with your financial goals, and deposit the required amount. Once the term is up, you'll receive your original deposit along with the interest earned. Number 3. Treasury securities. A risk-free investment with government backing. What if your investment was backed by the U.S. government? Treasury securities, such as Treasury bills, T-bills, Treasury notes, T-notes, and Treasury bonds, T-bonds, are debt securities issued by the U.S. Department of the Treasury. These investments are considered virtually risk-free because they are backed by the full faith and credit of the U.S. government. What makes Treasury securities so appealing? Guaranteed security. Treasury securities are considered one of the safest investments because they are backed by the U.S. government. Unlike other investments, they are not subject to market fluctuations or economic uncertainty. This makes them a great choice for first-time investors looking for a safe, stable investment. Tax advantages. The interest earned on Treasury securities is exempt from state and local taxes, which can be a nice bonus for investors. However, it is still subject to federal taxes. This tax advantage can make them especially attractive to individuals in high-tax states. Predictable returns. Treasury securities offer fixed interest payments over a set period, and you know exactly how much you will earn. This makes them ideal for those who want predictable returns and a stable income stream. Are there any downsides? Low returns. The primary trade-off with Treasury securities is the low returns they offer. Because they are so safe, they generally provide much lower returns compared to other investments like stocks or bonds issued by private companies. Interest rate risk. Treasury securities can lose value if interest rates rise. When interest rates increase, the value of existing Treasury securities tends to fall, which could result in a loss if sold before maturity. However, this risk is minimized for long-term holders, as the securities will eventually mature at face value. How to get started? To invest in Treasury securities, visit the Treasury Direct website, where you can buy them directly from the U.S. government. You can choose from a range of options, including short-term T-bills, medium-term T-notes, or long-term T-bonds, depending on your investment goals. Treasury Direct is user-friendly and allows you to manage your investments online. Low-risk investments can be a smart starting point. Are you ready to start your investment journey, but unsure where to begin? These 3 low-risk investments, Treasury securities, CDs, and high-yield savings accounts, are fantastic options for first-time investors who want to grow their wealth without taking on too much risk. Each offers a unique set of benefits, from government-backed security to fixed returns and easy liquidity. Remember, it's not about taking huge risks right out of the gate. It's about building a solid foundation. By starting with these low-risk options, you're setting yourself up for a future of financial growth, without the stress of the stock market's ups and downs. If you enjoyed this content and found it helpful, don't forget to give this video a thumbs up and subscribe to our channel. You'll be the first to know when we share more helpful videos and tips to make your financial journey easier.